What do you mean by banking sector reforms? Banking sector reforms in India refer to the initiatives and measures taken by the government and regulatory authorities to strengthen and improve the functioning of the banking industry in the country. These reforms aim to enhance transparency, efficiency, and stability of the banking sector, promote financial inclusion, and ensure the availability of adequate credit for economic growth. Some key elements of banking sector reforms in India include: Number 1. Liberalization. The banking sector reforms began in the 1990s with the liberalization of the Indian economy. This involved reducing government control, allowing private and foreign banks to enter the sector, and promoting competition. Number 2. Capital adequacy. The Basil Norms, specifically Basel 1, 2, and 3, were adopted to improve the capital adequacy of banks. These norms mandate banks to maintain a minimum level of capital to absorb potential losses and ensure financial stability. Number 3. Asset quality. Steps were taken to address the issue of non-performing assets, NPAs, or bad loans. The Insolvency and Bankruptcy Code, IBC, was introduced to expedite the resolution of stressed assets and improve recovery mechanisms. Number 4. Governance and risk management. Reforms focused on enhancing corporate governance practices in banks to ensure transparency, accountability, and effective risk management. Measures like the establishment of the Banking Codes and Standards Board of India, BCSBI, were taken to strengthen customer protection. Number 5. Financial inclusion. Initiatives such as the Pradhan Mantri Jan Dhan Yojana, that is, PMJD, aimed at ensuring financial inclusion by providing access to banking services to unbanked sections of society. The use of technology, such as mobile banking and digital payments, has been promoted to enhance financial access. The sixth element is regulatory framework. The Reserve Bank of India plays a crucial role in implementing banking sector reforms. It has introduced various regulations and guidelines to strengthen prudential norms, risk management, and supervision of banks. The next element is merger and consolidation. To create stronger and more efficient banks, the government has encouraged the merger and consolidation of public sector banks. This aims to improve operational efficiency, reduce costs, and enhance the ability to meet capital requirements. The last element is financial technology or fintech and innovation. The banking sector reforms also promote the adoption of financial technology and digital innovation. This includes the development of payment systems, fintech startups, and regulatory sandboxes to encourage experimentation and foster innovation. One of the important banking sector reforms in India is Basil Norms. Basil Norms, also known as Basel Accords, are the international banking regulations issued by the Basel Committee. The Basel Committee was established in 1974. This committee set standards regarding various banking supervisory matters. The main aim of these standards is to ensure the coordination of banking regulations worldwide. Another important banking sector reform was relating to the risk management. Risk management in banking sector indicates the process undertaken by a bank to identify and evaluate and take steps to mitigate the possibility of bad happening from its operations. This is especially important in banking because the banks are responsible for creating and managing money for others or third parties. As a part of risk management, the bank separates fraud and compliance operations, responsible for managing risk associated with fraud operations. Non-performing asset management was another important reform taken place in the banking sector. NPA stands for non-performing assets. Reserve Bank of India defines non-performing assets as any advance or loan that is overdue for more than 90 days. Depending on the length, there are three types of NPAs. First one is substandard assets. An asset is classified as a substandard asset if it remains as an NPA for a period less than or equal to 12 months. Second type of NPA is doubtful assets. An asset is classified as a doubtful asset if it remains as an NPA for more than 12 months. And the third type is loss assets. An asset is considered a loss asset when it is uncollectible or has such little value that its continuance as a bankable asset is not suggested. However, some recovery value may be left in it as the asset has not been written off wholly or in parts. NPA management was implemented by the Reserve Bank of India from the year ended March 31, 2004. So, this is all about today's class. I hope you've enjoyed today's class. I request you to support us by subscribing to our channel. So, we could see in the next class. Till then, bye. See you. Stay tuned.